Companies with healthy cash flows and a steady growth outlook. These are the low P/E stocks to buy for a potential reversal rally in the second half of 2023. Pfizer. Deep clinical trials pipeline and aggressive acquisition-driven growth. Chevron Corporation. Investment-grade balance sheet and low break-even oil assets. AT&T. A deleveraging story with encouraging growth in key business metrics. Let's dive in. Here are the 3 low PE stocks that are bound to rebound this year. Welcome to Timely Investment Research. Be it growth or blue-chip stocks, a key success factor is to invest in undervalued names. This might sound simple, but the rule is often ignored. There are low PE stocks in challenging market conditions, and with fear being the dominant sentiment, investors stay away. When the valuation gap closes and the market surges, stocks tend to be bought. As an overview, the price-to-earnings ratio is the most commonly used valuation indicator. It tells us how much an investor will pay in the markets for every dollar of the company's earnings. As the markets face multiple headwinds, it's easy to find low PE stocks. Given the macroeconomic scenario, I would also bet on relatively easy monetary policies in the second half of 2023. This could translate into a reversal rally for stocks. Therefore, it's a good time to accumulate undervalued stocks. Let's discuss 3 low PE stocks that are worth considering. Number 1. Pfizer. Pfizer stock seems significantly undervalued at a forward PE of 11.8. The 4.1% dividend yield stock has declined by 23% in the last 12 months. Considering the valuation, it seems that the worst of the downside is done. From a business perspective, there are several positives. Pfizer has a deep pipeline of 110 drug candidates in clinical trials. Of these, 23 are in phase 3, and 16 are in the registration phase. The launch of new drugs will support revenue growth. Pfizer has also been active on the acquisition front. The company is targeting $25 billion in risk-adjusted revenue from new business developments as of 2030. Recently, the biopharmaceutical company announced the acquisition of Seagen for a consideration of $43 billion. Of course, cash flows from the COVID-19 vaccine will decline. However, that factor is discounted in the stock. Given the low PE and an attractive dividend yield, I expect a reversal rally for Pfizer stock. Number 2. Chevron Corporation. Chevron Corporation stock has been almost sideways in the last 12 months. The stock performance has been resilient, considering the oil price has corrected in the previous few months. At a forward PE ratio of 10.3, Chevron Corporation stock looks attractively valued. The stock also offers a healthy dividend yield of 3.87%. Chevron is the best name among oil and gas stocks for 2 reasons. First, the company has an investment-grade balance sheet. Furthermore, Chevron has low break-even assets. Last year, the company reported an operating cash flow of $47 billion. Even with a decline in oil prices, it's likely that operating cash flow will remain robust in 2023. With high financial flexibility, Chevron targets annual investments in the range of $13 to $15 billion annually. Investments will ensure that cash flows remain healthy. At the same time, the company will have ample flexibility for dividend growth and value creation through share repurchases. Number 3. AT&T stock has been subdued after the spin-off of the media division. At a forward PE of 7.5, the stock looks undervalued. AT&T stock also offers an attractive dividend yield of 6%. A major positive related to AT&T is deleveraging. Last year, the company reduced net debt by $24 billion. Deleveraging is likely to continue in 2023, and as credit metrics improve, the stock will trend higher. It's expected that the company will sell off its cybersecurity division to accelerate the deleveraging process. Business developments have also been positive for AT&T. For the current year, the company has guided for a free cash flow of $16 billion. Healthy growth in postpaid phone and fiber subscribers will support strong cash flows. The company has made significant investments to boost its 5G infrastructure. This will yield results in the coming years in the form of subscriber growth and potentially higher average revenue per user. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.